Hello, everyone, and welcome. Good to see you all, and thank you for attending today our May webinar with our partners from Outlier. We'll just give a few minutes to everyone to log in. I see the numbers going up as I'm speaking, so that is great. While people are logging in, I'm just going to quickly do a brief introduction while you all get settled in. My name is Beatrice Thurdeman, and I'm the Managing Director of the Canadian Jewelers Association. The CJ is the voice of the Canadian jewelry and watch industry, representing a membership consisting of retailers, suppliers, designers, and wholesalers across Canada. We're here to provide ethics, education, communication, and crime prevention. And we're thrilled to have you with us today for an Anti-Money Laundering 101 webinar. All dealers in precious metals and stones in Canada are required to train staff in anti-money laundering practices on an ongoing basis. And Outlier Compliance Group and the Canadian Jewelers Associations have been working together for many years to help you meet this obligation. Today, I have with us our wonderful and beloved partners from Outlier, Amber Scott and David Vijan. Hi, Amber. Hi, David.
Hi.
Hello.
How are you?
Very well, thank you. How are you today, Beatrice?
Not too bad, thank you. Amber and David's areas of expertise include Canadian anti-money laundering, counter-terrorist financing, privacy, and regulatory compliance. And Outlier has created an online, on-demand anti-money laundering and counter-terrorist finance compliance tool for dealers in precious metals and stones, including the wholesalers and retail jewelers. And this toolkit is actually free for Canadian Jewelers Association member who enjoy discounts on also consulting services through Outlier. What's fabulous about this AML kit is its value is very high. It's around $2,700 for the compliance kit. And as a CJ member, that is received for free courtesy of Outlier. Welcome everyone, and a few things before we start. Please keep an open mind and positive atmosphere throughout. We ask everyone to stay muted for the entire time. Please ask your questions politely and respectfully in the Q&A section. We also sometimes see them in the chat. We'll get to them towards the end, if you're okay with that, just to allow David and Amber to go through their presentation. David, Amber, thank you for being here today. All yours.
Perfect. Thank you very much for having us. By quick way of just a couple of housekeeping items, David and myself are not lawyers, although we will be talking a fair bit about the law, so nothing that we say should be considered legal advice. We don't represent any government or government agencies, so we'll be talking a fair bit about FINTRAC and law enforcement, but if FINTRAC or the RCMP says something differently, please listen to what they have to say. We're going to discuss a few different situations, and if you have questions that you drop into the Q&A, we'll ask that you drop them in terms of generalities, which is to say, don't drop in any information about names of businesses or any personal information about individuals. If there's something like that that needs to be addressed, then let's do that outside of this semi-public forum that we're in currently. And this is a recorded session that will be posted publicly, so we want to make sure that we're not exposing any personal information that we shouldn't be. And finally, information should be free. So if you want to use any aspect of this presentation as part of your annual training, which is one of your obligations as a dealer in precious metals and stones under anti-money laundering regulation in Canada, we welcome you to do that. And if you do that, the caveat that I will give you is that you also need to talk about your own policies and procedures. So this is really great information. We encourage you to share it with all of your staff, but you also need to talk about what you specifically do as a business and your specific policies and procedures, who is your compliance officer, etc. So without further ado, let's talk a little bit more about anti-money laundering and counter-terrorist financing. Those are those first two acronyms. So AML is anti-money laundering, CTF is counter-terrorist financing. And in terms of the basics, anti-money laundering is just taking the proceeds of crime. So there are all different sorts of crimes that generate profit and proceeds, and criminals want to take those proceeds and hide the source. So they want to disguise where that money came from and make it look like it's legitimate, hide it within the financial system, and be able to live lives, purchase homes, purchase jewelry, and do all of the things that regular folks do. Under the Proceeds of Crime, Money Laundering and Terrorist Financing Act, certain types of entities, which include dealers in precious metals and stones, have to take steps to prevent, detect, and deter money laundering and terrorist financing. And those are the types of things that we're going to be talking about today. In terms of how money is laundered, this process is often described as having 3 steps. And in the placement steps, those funds that came from crime, regardless of what the crime was, we don't need to know what it was, but the funds that came from crime are placed somehow into the financial system. So this is often, but not always, in cash. It can happen in the form of e-transfers. It can happen in wire transfers. It can happen by checks. In the case of check fraud, it can happen in virtual currency. So it's important to note that in this placement stage, we're not just thinking about cash. This can happen in a variety of different ways. And this may happen, for instance, with someone just making a purchase of a gold bar. So you may see that placement in that way. In the layering stage, you see funds move between accounts from person to person, from country to country. And the aim here is often to make it really difficult for law enforcement or any other authority to follow the trail to determine the true ownership of those funds or of those assets. And so in our example, following our gold bar, the gold bar might be transferred to a custodian in the name of a nominee. So you might have someone else, a nominee owner, who isn't that true owner who did the initial purchase, just to separate that ownership from the criminal and from the criminal funds. And so eventually that gold is sold, and now the nominee has received a check or a wire transfer. So we have money now that's been received for that gold bar. And in the integration stage, so in the final stage of money laundering, those funds appear to be legitimate, and they're used to purchase goods and services. And this can be investments, it can be real estate, it can be really anything, including, again, things that we might purchase in the DPMS sector. So again, following through in our example, here the nominee purchases property. So it might be automobiles, boats, etc. And this purchase appears to be very legitimate. And this ultimately benefits the criminal. And so the nominee has now purchased an automobile, but it's not really for them to use. It's actually something that they've purchased, and the criminal is ultimately using that automobile. And if you're looking at this example and saying, wow, it would be really hard to detect this in some instances, you're absolutely correct. And this is part of why there are certain things in place and why we have to pay attention and do transaction monitoring and pay attention, because things aren't always what they seem. The second part of this training, so we have anti-money laundering, and we also have that CTF, counter-terrorist financing. And terrorism is something that involves any attempt to influence or intimidate the government or the public at large, often through violent or illegal means. Terrorist financing, in turn, is any act or omission, so anything that we do or anything that we don't do that helps to fund an act of terrorism. The difference between these two things is that with anti-money laundering, we always start with a crime, whereas terrorism and terrorist financing, there's a crime at the end, but the funds may actually come from a variety of different sources. And we have a number of cases in our Canadian context where funds have been raised through things that appeared to be legitimate charities. They were actually registered at charities as charities. And it wasn't clear if the people donating to the charities were aware of how the funds were ultimately intended to be used. But the commonality between anti-money laundering and terrorist financing is that as the funds move through the financial system, there's an attempt to separate the source of the funds from how the funds are ultimately used. And so you see these things that just seem a little bit funny and a little bit different because they're trying to separate the funds, trying to make the transactions confusing. And those are things that we need to pay attention to. In terms of dealers in precious metals and stones, presumably this is everyone that is on this webinar today. These are one of the types of reporting entities under Canadian legislation, and this includes banks, credit unions, money services business, casinos. There's a number of different types of regulated reporting entities, of which we are one, that are required to comply with Canadian legislation in order to prevent, detect, and deter money laundering and terrorist financing. As such, our regulator is the Financial Transactions and Reports Analysis Centre of Canada, also known as FINTRAC for short. And they are our financial intelligence unit, as well as our regulator. So they are our watchdog from a money laundering and terrorist financing perspective. As a dealer in precious metals and stones, we submit reports to FINTRAC. They also have the right to examine or audit us. And if we're out of compliance with our requirements, they can levy penalties against us. As such, it's important that we take all correspondence with FINTRAC very seriously. And so it's important for folks that are staff generally to know that if you're not the compliance officer in your business, but you get a phone call from FINTRAC or you get a letter from FINTRAC, it's important to make sure that that's passed to the person who's your compliance officer as soon as possible. So you want to make sure that they know about that and that they're able to respond to it quickly. Most of the time when something is coming from FINTRAC, you have a strict timeline in terms of when you respond to it. And so these aren't things that we can just leave hanging and not respond to. In terms of non-compliance, so if we don't do the things that we're supposed to do, there are a couple of different paths that can happen. So there are administrative monetary penalties, which are civil penalties. That's what we see most commonly in the case of non-compliance. And there are also criminal penalties. I can't stress enough that criminal penalties in the case of industry are relatively rare. In order to see something like a criminal penalty, you would really have to be complicit, which is to say that this isn't just an oops, we tried our best and we filed a report late and we made an honest mistake. These are cases where you are aware that there is criminal activity happening and you are basically participating in that criminal activity, you're aiding in that criminal activity, you are willingly part of the money laundering process and actively, knowingly laundering money. Those are the types of cases in which you see criminal penalties. I hope that's not anyone with us on the line today. And so we're going to set that aside and just talk about administrative monetary penalties, which we see much more commonly. Those administrative monetary penalties can be quite high. We have seen increasingly administrative monetary penalties occurring, as well as administrative monetary penalties occurring in the DPMS sector. And these are different depending on the type of violation. So a violation means that you had an obligation, you were required to do something under Canadian legislation, and either you failed to do that, and a failure just means that it didn't happen. So we were required to have a compliance officer, we failed to have a compliance officer, means that we just didn't have a compliance officer, or it wasn't sufficient. And so there, for instance, in the compliance officer example, your compliance officer has to be able to do certain things. So they have to be qualified to do the job. They have to have access to your senior management. So they have to have sufficient resources to do their roles. So it might not be a complete failure. You might have had a compliance officer, but maybe you just said, hey, our newest customer service person who's only ever here on the weekends, that's going to be our compliance officer. And she's just doing that off the side of her desk. That would be an example of where you had a compliance officer, but it wasn't sufficient because that's not the right person for that role. She just didn't have the experience and the resources and the ability to do that within your organization. So depending on the type of violation, those penalties are different in terms of the dollar amount, and they can be relatively severe. They can also result in the publication of the entity's name on FINTRAC's website. And that's really problematic for entities. It can cause problems with your relationships with your suppliers, with your customers, with your banks, and your other types of service providers. And that's something to be aware of. So here's an example of something that was published on FINTRAC's website. So this is public, it's publicly available. And you can see on a high level those 5 violations that have occurred in this case. So there were issues in terms of developing the compliance program, as well as reporting certain types of transactions that need to be reported. And those include large cash transactions and suspicious transactions. And we're going to talk about that a little bit more in terms of exactly what those mean. But you can see that this administrative monetary penalty is substantial. So it was just over $200,000. And this is something that you can see within the publication that the dealer in precious metals and stones is actually appealing this in federal court. But even pending that federal court appeal, this is still something that's currently published on FINTRAC's website. And I will pass it over to David at this point to talk a little bit about what those obligations to FINTRAC look like.
Before we go to David, Amber, if you don't mind, there's a question that ties to what you talked about.
Yes.
How will FINTRAC usually communicate with retailers? Is that phone, text, letter? Can you clarify?
Oh, absolutely. So FINTRAC will communicate by phone as well as by letter and by email. So when you have an examination, and I have to be clear, things like these penalties result from an examination. When you have an examination, FINTRAC will first call you on the phone. They will identify themselves as being from FINTRAC. They will let you know that you're going to have an examination. So they'll ask to speak to your compliance officer. They'll let you know that you're going to have an examination. And then they will follow up with a specific information request that you will receive either by email through Canada Post ePost or through the actual physical mail. And I would suggest, because it just leaves a fabulous audit trail, so it's quite secure and you can see what you've uploaded and what you've actually received in a very timely way. And I think we all have email at this point, which means that you can access ePost. So to the extent possible, use that option, even if you're not generally a fan of high technology. It's going to be helpful and make your life much easier and much more efficient in the case of a FINTRAC examination.
All right, so let's talk about the obligations now. So first off, what are the laws and regulations that regulated entities such as DPMS need to follow from an AML perspective? The overarching piece of legislation is the Proceeds of Crime, Money Laundering, Terrorist Financing Act. And under that, there are 5 regulations. The regulations is really where your obligations are spelt out in terms of the things that need to be done. To help it make more sense and to be more clear, the regulator FINTRAC, they do publish guidance to help with regulated entities such as DPMSs to comply. There is the Criminal Code of Canada, as Amber mentioned. That is what essentially is the piece of law that makes money laundering illegal, but also knowingly assisting in money laundering illegal. There is also ministerial directives, and ministerial directives can be about anything, and these are published by the Department of Finance. Currently, there are 2 active ones. One relates to North Korea and prohibits certain types of transactions to North Korea. And the second one is related to Iran. And that one's a little bit different. There isn't transactions that are prohibited per se, but transactions that have certain touch points related to Iran should be considered high risk. And there's some additional reporting that has to be done there. Also, you'd have to consider that from a suspicious transaction perspective. And we'll talk about that, what a suspicious transaction is a little bit later. And then there's also sanctions. And this is referred to as list screening or watch list screening, but essentially it's ensuring that you are not dealing with terrorist or terrorist organizations. We can go to the next slide, Amber. So what are our responsibilities under Canadian law? Essentially, there's 2 parts, the Canadian compliance program and then your operations. The compliance program is made up of 5 elements. A compliance officer, as Amber mentioned, this is somebody that would be responsible for the compliance program. They should be senior enough that they have access to senior management and the board. They're responsible, so they should be able to make decisions fairly easy. It shouldn't be somebody junior within the organization. Policies and procedures. Policies and procedures essentially are the documents that you would have in place. Policy is a higher level document that outlines all your obligations under law, but then the procedure documents are how you're actually complying and the processes in place to ensure you're meeting those obligations. A risk assessment. Essentially, this document is a document that lays out all the possible ways that your business can be used to launder money, but then all the mitigating controls in place to make sure it doesn't happen. Compliance effectiveness review. This is an obligation under Canadian law that applies to all regulated entities, and it has to be done every 2 years. So as a DPMS, you need to have an external review every 2 years. This can be completed by somebody internal, so long as they're independent from the compliance function and they have enough knowledge about AML. It can be done in-house, but essentially it is a review of your compliance program and then also your operations. And then the last piece is training, which is what we're doing here today. And as Amber stated earlier, feel free to use this as training internally to meet that obligation, but you do need to talk a little bit more in detail about your policies and procedures. From an operational standpoint, there are certain things that have to be done. There are certain types of reports that have to be reported, and we're going to talk about what reports apply to the DPMS sector shortly. Record keeping, identifying customers in certain situations, customer risk, and transaction monitoring. And we're going to talk about those in a little bit more detail shortly. So your compliance program needs to be kept up to date. And essentially, this needs to be updated at least once annually. If your business model changes or the regulatory landscape changes, if there's a lot of legislation changes, it should be more frequent. But at a minimum, your policies, procedures, risk assessment should be done at least annually. Your training must be delivered at least once a year to staff, and it should be to all staff that interact with customers or customers' transactions. If you do have any sort of back office functions, or and a good example would be something like a cleaning staff or something that you employ, they don't need to take it. They're not necessarily engaged with customers and transactions, but it is not just your customer facing. You do need to think back office as well. Compliance officer appointment, as I stated earlier, you do need to have a compliance officer in place, but you should have that formally documented. And anytime there is a change in compliance officer, you're documenting that again. And the effectiveness review, as I stated, has to happen every 2 years. Next slide, please. All right. So record keeping, at a federal level, all AML program and operational documents, this includes identifying customers, transactions, things that you report to the regulator, have to be kept for a minimum of 5 years. And this meets your AML requirements. There are other considerations sometimes that have to be considered from a tax perspective, from a legal perspective, but from an AML perspective, it's 5 years at the federal level. If you do have operations in other provinces, such as Quebec, that may be a little bit longer. We can go to the next slide. We'll talk about reporting in a little bit more detail. So certain types of transactions have to be reported to FINTRAC. All the reports have different timeframes of when they need to be reported. So it's important to let the compliance officer know so they can conduct investigations and gather information to make sure that they meet the reporting timelines outlined. And we'll actually talk about that on the next slide. So as a DPMS, these are the reports that have to be sent to FINTRAC and the timing that goes along with it. So large cash transactions, and we're going to talk about what that is in detail, has 15 days from the date of the transaction that has to be reported to FINTRAC. If you accept virtual currency, large virtual currency has a 5-day window for reporting from when the amount is transferred. Suspicious transactions and attempted suspicious transactions have to be reported as soon as practicable after completing the measures that enable a determination of reasonable ground. So after you have suspicion and the compliance officer conducts an investigation and you determine that it is reportable, that as soon as practicable, which is basically somewhere in between immediately and as soon as possible. And basically what FINTRAC expect is the reporting is taken priority over other things. And the last is terrorist property. If you do ever have one of these, it needs to be reported immediately. And this one actually doesn't just go to FINTRAC, it also has to be reported to law enforcement as well. So just keep that in mind. Large cash. So large cash transactions are any transactions valued at $10,000 or more. And this is in a single transaction or multiple transactions within a 24-hour period. one thing I do want to make clear here, this is physical cash. So it is bills and coins. It is not check. It is not a bank draft. It is actual physical cash. If somebody comes in within a 24-hour period and they do, a 3,000, 3,000, 4,000, and 4,000, all that together does add up to $10,000, and that would have to be reported to FINTRAC. When there is a large cash transaction, you have to take steps to identify the customer before you can complete a large cash transaction. It's okay to tell the customer that you are reporting this, and that's why you're obtaining such information as identification. That's perfectly fine. Large virtual currency. So this is very similar to the cash reporting obligations. As I mentioned, it has a different reporting timeline, but it's the same concept of receiving virtual currency, $10,000 or more within a 24-hour period, whether that be one transaction or multiple transactions. For large virtual currency, it could be, and just for clarity here, this is not a digital payment such as an Alipay or something of that nature, but it is a Bitcoin or Ether, those types of cryptocurrencies, if you will. And accepting multiple cryptocurrencies from a customer. So a customer comes in and pays, 5,000 in Bitcoin and 5,000 in Ether. That is equivalent to $10,000, and that would be reportable if those two transactions happened within a 24-hour period. Again, the customer needs to be identified, similar to a large cash, and it's okay to tell them. That's why you're gathering that information. Yeah, we can go to the next one. So the 24-hour rule, let's talk about this one a little bit. It's an interesting concept here. So the 24-hour rule, this really relates to the multiple transactions within a 24-hour period, but if it's conducted on the behalf of the same person or by the same person. So if you have multiple store locations, you need to have a mechanism in place to say, oh, well, David bought, something in $5,000 cash at location 1, but then he bought something in cash at location 2, because together I'm the same person buying at multiple locations, but that does equate to a $10,000 transaction because I went in on the same day to 2 multiple locations. It can also be on behalf of the same person. Sorry, Amber, go ahead.
I didn't mean to interrupt you. I just had a quick question. What happens if I put something on layaway and I'm paying you $1,000 in cash every 2 weeks when I get paid, but the item is worth more than $10,000 in total?
So layaway items are not really captured under the 24-hour rule. Somebody that comes in and does that $1,000 payment every week, that's not captured. If there was somebody said they wanted a layaway plan and say put $1,000 down, but then later came back that day and said, oh, I changed my mind. I had some extra money at home. Here's the additional $9,000. That within the same day equals $10,000, and that's reportable. So yeah, not a true layaway. It's not meant to capture that. It's really within a 24-hour period, whether that be multiple or one. So we can go to the next slide. In the cases of large cash and large virtual currency, we need to do what is called a third-party determination. And basically this is asking the customer if they're completing the transaction for someone else other than themselves. And a lot of times that answer is going to be no, and you've met your due diligence there. But if the answer is yes, I'm conducting it on behalf of somebody, there is information that you need to collect. And that information really pertains to the name, the address of that person, and the relationship between the two. For clarity, this is not going to be the situation where, an engaged couple come into the store and, one is pointing out, I want that ring, and the other one is paying for it. It's not meant to capture that. It's not meant to capture, I'm buying a gold coin or a nice watch or a piece of jewelry for my mother for Mother's Day. That's not really a true third-party transaction. Third party is somebody acting in the background that doesn't want to be identified, that doesn't want to be connected to the transaction, but has given the instruction and likely given the money to complete the transaction. Let's go on to the next one. Thank you. So unusual transactions. So if you have reasonable grounds to suspect that a transaction is related to money laundering or terrorist financing, as I stated earlier, you do have to identify the customer, but you need to report this to the compliance officer as soon as possible so the compliance officer can do an investigation to determine if it truly is something suspicious or if it's not. And if it is something that they determine to be suspicious after the investigation, they are reporting that to FINTRAC. It's important to note that there is no minimum dollar value. So sometimes there is the misconception of, a $40,000 transaction for my business is always suspicious, but that's not always the case. It could be a very low transaction and it has to make sense for your business. Transactions may involve cash, but as Amber stated, it may be virtual currency, it might be an EFT. So it's not always cash. Cash is, most common, but it does not necessarily involve cash. As I stated, report everything to the compliance officer, even a hunch, that's when you're reporting to the compliance officer. What's important to note here is, unlike large cash and large virtual currency transactions, you do not want to tell the customer you are suspicious of them. That is called tipping off, and that is illegal. But you want to still try to identify the person. So you're going to say that it's company policy for me to request this information and kind of leave it at that. Let's go on to the next slide. So the stages of suspicion. Simple suspicion, essentially, I mentioned earlier, is a hunch. Something seems a little bit off. And then there's reasonable grounds to suspect. And once that threshold of reasonable grounds to suspect, that is when you are reporting to FINTRAC. So once there's simple suspicion, that's going to the compliance officer. Once there's reasonable grounds to suspect, that is being determined to FINTRAC. And then there's also reasonable grounds to believe, which is a definite reporting to FINTRAC, because there is a high probability that money laundering is occurring. We can go to the next slide. So what do I look for? What do I look for from a customer behavior perspective? And the truth is, it's sometimes hard. There's no single indicator that's going to work every time. These customers or people involved in this are usually very, they're professional. They can be very deceptive and convincing. They may take the tactic of being flirtatious and very nice to gain trust. There's others that might actually say and threaten to escalate to manager, so you would be able to help them out. But really, it's about going with your gut and trusting your instinct. And when you are in doubt, just escalate to the compliance officer, and the compliance officer will do the job of further investigation. Go to the next slide, please. So what indicators do I look for from a transaction perspective? And this is where it's going to be about, it's unusual for the customer. Does it make sense based on what I know from the customer? So an example, across the street, there's somebody that comes into our jewelry store every week and is buying a gold coin, but they work across the street at Tim Hortons as a cashier. Well, does that necessarily make sense? It may not. So that is something that you would have to kind of use your judgment and what you know about the customer, and then you would escalate accordingly. Here are some examples of indicators that need definite reporting. So a customer changes their transaction amount to avoid any sort of identification. So, they come in with that $10,000 in cash and you're like, well, I need your ID. And they're like, okay, well, I'm only going to pay $7,000 cash. And then I'm going to put the rest on, I'm going to write your check or credit card or something like that. Because they're trying to avoid identification thresholds, you do want to report that. A customer refuses to be identified. That is something that needs to be escalated and reported as well. If you believe the customer has provided false or misleading information, so you ask for identification, but it's clearly a fake ID, that's something that should be reported. And sometimes customers are proud of their activities from a criminal perspective, and they may actually say, yeah, this money is from drug dealings or so forth. That is something that you would definitely want to escalate and report accordingly.
Sorry to interrupt. You do have a question that ties right into that.
Yeah.
If you'd allow, will the 24-hour rule, if the customer pays $500 by check and returns within 24 hours with $9,500 cash, does this have to be reported?
No, not from a large cash perspective, but you may want to consider that transaction from a suspicious transaction perspective, especially in that instance where the check is a smaller amount and the cash is a larger amount. Something seems a little bit off. So you may want to think about that from a suspicious transaction, but from the large cash reporting perspective, that one is not, because it is only $9,500 in cash. So terrorist property. If you are in possession of property, and this is actual funds, so cash or physical goods, so a piece of jewelry that you are perhaps holding for a customer that is a terrorist, you need to notify the compliance officer immediately. They need to report, sorry about that, turn that off. They need to report to the compliance officer. The compliance officer needs to report that to FINTRAC immediately, and then they need to report that to CSIS and the RCMP immediately. The compliance officer actually also needs to report a suspicious transaction as well. So they're filing both a terrorist property report and a suspicious transaction. And the suspicious transaction is because you have met reasonable grounds to suspect that the transaction is connected to terrorist property. Yep, you can go on, Amber. So sending reports to the compliance officer, I think we've kind of said this throughout, but immediately, as soon as possible, send things to the compliance officer so it gives them enough time to do an investigation and gather enough information and meet the deadlines that they need to meet for reporting to FINTRAC. And remember, you are protected. So it's very unlikely that a customer would ever know that you filed a report. FINTRAC basically shares this information with law enforcement, so when law enforcement can do an investigation. But as long as you are reporting in goodwill, you are protected. If you are, if you had a bad breakup and are doing a suspicious transaction report on your ex just because you don't like them, that's not in good faith and you're not protected under law. But if you are genuinely trusting your instinct and you have that reasonable grounds to suspect and you report, you are protected. Yeah, we can go on. And we've been talking a lot about identification, but what does that exactly mean under AML obligations and when do you need to do that? I'm going to turn it over to Amber so she can walk you through that a little bit.
Perfect. Thank you, David. And when we talk about identifying customers, I have to be clear here that we're talking about identification under the Proceeds of Crime, Money Laundering, and Terrorist Financing Act. And that only applies in very specific circumstances. So we're talking about if you have a large cash transaction, if you have a large virtual currency transaction, so $10,000 in cash or virtual currency within the same 24-hour period, then you are required to identify the customer. If you have a suspicious transaction, you are required to attempt to identify the customer if you can do so without tipping them off about the idea that you're suspicious. So there's always a bit of nuance, and can you do that? And if you can't, then you keep a record of the reason that you don't think that you could have done that at the time. And if that's the case, and you have to identify the customer, then there are very specific methods of identification that you need to follow in these circumstances. And there are also specific records of information that you need to keep. So it's not enough to just look at the ID and say, yep, that's you. But you actually have to keep records of certain types of information. So when you're looking at a piece of ID, if the person is there, generally the path of least resistance is that you would look at a piece of government issued photo identification. So it has to be issued by a government. It has to have a photo. The photo has to match the face of the person. It has to be authentic. It has to be valid. It can't be expired. It needs to include the person's name. It has to have a unique identifier number. So this is a passport number, driver's license number, those types of things. And if the person is not there, so if you're talking about an online transaction, you can actually use the government issued photo identification method, but there needs to be some sort of electronic face matching to say, yes, this is the person, as well as to show that this is a valid ID. So there has to be something to look at it to say, yes, this really is an Ontario driver's license, as opposed to something that I've drawn in crayon. And yes, this really is my face. And that needs to be happening whether it's in person or online. If it is online or remote, then that needs to be happening electronically. So it's not enough that they just upload an image and you're looking at it in the background. It has to be something that's a digital matching of the face. One of the contentious issues that we have, because it is a government issued photo ID, is provincial health cards. And there's provincial legislation in most provinces that prevents us from using the health card to do anything other than accessing health services. And so if this is something that you want to use, it's important to make sure that you know which provinces have a prohibition. It is most of them. And so in most cases, we just don't recommend using a health card as a form of identification. There are a few other identification methods that you can use. So you can use a dual process method. And this just means taking information from two different sources, two different reliable sources. So you have to believe that those are sources that you can rely on, that you can trust to verify that person's name and address, name and date of birth, or that they have an account with a Canadian financial institution. So you have three possibilities there, and you have to do 2 out of 3 from 2 different sources. So you can't go, for instance, to RBC Bank to get 2 out of 3. You have to get 1 from RBC and 1 from somewhere else. And you have to keep records, again, in this case, of those things. So for instance, if you're doing this remotely, you could actually get a copy of someone's ID. So you get a copy of my driver's license, and that has my name and date of birth. And then you could get something else that has my name and address, like a utility bill. You would need to look at it to know that you think that that is a recent utility bill. So it can't be a utility bill from 1996. That would be problematic. And it has to be something that is authentic. So again, if it seems like I drew it in crayon, that's not something that you could accept. In terms of organizations, if your customer is an organization, you need to collect information about that organization in the event that you have to do the identification. So again, large cash transaction, large virtual currency transaction, suspicious transaction, these are the instances that we're talking about. You need to get proof that the organization exists. And there's a number of different ways to do that. Again, that needs to be relatively recent information. If it is a Canadian company or Canadian organization, there is a business registry that's in a beta format right now that's fantastic to be able to consult, to at least be able to get that first piece, and sometimes some of this second piece. We are moving towards a beneficial ownership registry in Canada, but we do not have this information as yet. It is within our government's plan, so I think that we'll see it at some point, but we don't have it currently. So you do also need to confirm who owns or controls 25% or more of that organization, either directly or indirectly. You also need to ask whether the organization is a not-for-profit. And if they're a not-for-profit, you ask a couple of additional questions, like whether they're a registered Canadian charity and whether they solicit donations from the public. If identification fails, you need to document this. And in the case of an entity, if you can't confirm the beneficial ownership, then you try to identify the senior most executive, and you need to consider that organization high risk. In these cases, I think you really also need to assess whether or not that customer as an organization is within your risk tolerance, which is to say that if I don't know who's behind a company, am I really willing to do business with that company? Are they within my organization's risk tolerance from a money laundering, terrorist financing perspective? And if you can't identify the person doing the transaction, then you would not be able to do a large cash transaction, of course, or a large virtual currency transaction. And there are no exceptions to this. So if you're at a trade show, for instance, and someone is doing the, oops, I forgot my ID, but I'd really like to buy this piece, you wouldn't be able to complete a cash transaction in that circumstance. There is also a concept of business relationships. So this doesn't mean a relationship with an entity. This could be with an entity or with an individual. And what it means is that you've conducted 2 or more activities that require identification within a 5-year period. And to add to the confusion that when we say business, we don't just mean an entity as opposed to an individual. When we say activity, the same transaction can represent more than one activity. So you can have one transaction in which it triggers 2 activities that would have required identification. So for instance, if I buy a watch from David and that watch is over $10,000 and I'm paying David in cash, and I happen to mention during this transaction that my side business of selling cocaine is going really well. And so David now has to report a large cash transaction and he has to report a suspicious transaction. We have 2 activities that required my identification. So he has to collect my identification. He has to do 2 reports. And now also we have a business relationship. And this business relationship triggers a couple of additional requirements on David's part. So he has to ask, why am I doing business with him overall? So what's the purpose and intended nature of that business relationship? And this can be things like purchasing or selling jewelry, watches, precious metals. So really he's asking, why am I doing business with him? And my answer is, I really like watches and I'm buying a watch, and that's great. And he records that and keeps a record of that. But that's another record that he needs to create. He also needs to determine whether or not I am a politically exposed person or the head of an international organization. Now, these aren't necessarily bad guys. Setting aside that in the example that I just gave you, I said that my cocaine business is going really well. Let's pretend that that's not what I had said, and just switch over to talking about politically exposed persons, or PEPs, and heads of international organizations. These are just people that hold specific roles. They can be either foreign or domestic. And when they're foreign PEPs, they are considered to be automatically high risk. When they're domestic PEPs, we have to make a determination about whether they're high risk or not. This also includes people that are in the immediate family of politically exposed persons, as well as close associates. And close associates might include someone like a boyfriend, girlfriend. In all of the guidance, mistress is listed, which always gives me a giggle. But if that's something that you know, then that would be someone that would be considered to be politically exposed. So there's a huge list, and this is in the regulations. It's in FINTRAC's guidance. It's in, if you're using our tool to generate your policies and procedures and risk assessment, this will also be included there. But there's a large list of roles in terms of who is considered to be politically exposed. It's a little bit different based on whether or not it's foreign or domestic. And again, we have the heads of international organizations. And the heads of international organizations are really meant to capture things that aren't specific to a country, but things like the European Union, for instance. So these big international organizations that wield significant power on the world stage. Also recently, thank you, FIFA, we have international sporting organizations that are also included in that category. Oh, and that actually brings us in I think record time to the end of our formal slides. But before I get there, I just realized that I forgot to ask about forgot to mention for the PEP determination part. There's a number of different commercial software that you can use to do a PEP determination. So you can have software that does name screening of your client database. And you can also just ask the person if they're politically exposed. But if you ask them, and you know that they're a politically exposed person and they say no, then that's problematic. So for instance, if you were to ask someone, but you know that they are actually a senator and they say, no, I'm not politically exposed, then you have a couple of different issues in terms of the risk associated with that person. And part of it is that they presented false or misleading information, because obviously that person knows that they're politically exposed and they've chosen to say otherwise. And so you can't just rely on that person saying no if you ought to have known better.
One other thing I'll add on the PEP front is for politically exposed foreign PEPs, they are always considered that. So they are high risk and they're always considered the PEP. If they're domestic, as Amber stated, you do a determination, a risk assessment to determine if they're high risk or not. But their PEP status, if you will, only remains for 5 years once they leave office or the position that makes them a PEP. Yeah. I think that's it.
Well, thank you guys. That's been great. We have already another question, actually 2 more. Would you like me to read them and you see who answers it? David?
Perfect. That's wonderful. But before we do that, I would like us to just stop the recording.
Right.
And that way we can just have a Q&A session with a little bit more candor that doesn't make its way to a public forum later.
Right. And just to clarify, so far we've recorded everything and the recording will be sent in the next few days together with a slide. So thank you for the reminder, Amber. The recording will go to everybody who has registered. And there we go.